Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about the top 10 dividend stocks for 2018 and beyond. Now, you guys may know I'm not a huge dividend investor. I'm more of a growth investor. However, dividends are phenomenal for three groups of people. One is the people that are just getting into the stock market. It's phenomenal to invest in dividend-paying companies. They're generally safer. They generally aren't as volatile. They're a good starting place when you're in like your first year of investing dividend stocks. Also, they're also good for people that don't want to deal with the volatility of growth stocks, right? Growth stocks, like stocks I invest in, they can be highly volatile. They can go up a ton, they can go down a ton. You never know. Perception can change. Maybe growth rates change, those kinds of things. So they're a little more risky growth companies. Dividend companies, especially the big dividend payers, that are well-established companies, generally they're a little safer. And lastly, if you're an older person, dividend companies are generally the way you want to go. You don't want to take as much risk as you get older. When I'm in my 50s, if I'm blessed enough to make it to my 50s, 60s, I will be heavily invested in dividend companies, and I will be almost invested in no growth companies or very few, guys. So those are the three groups of people that dividend companies are very good for. Maybe you're in that one of those three groups. But anyways, let's count this down from number 10 to number 1. Hope you guys enjoy. Hit that thumbs up button if you do, and let's get into this, guys. So number 10, coming in at number 10 is Sherwin Williams. They are a paint company. It's a company that, is a good company as far as anything painting related. So, houses getting painted, whether it's new houses, whether it's people going to Home Depot and Lowe's buying paint products to paint a room or whatever, guys. Very safe company, a company that's still going to be necessary 5 years from now, 10 years from now, into the future, guys. So Sherwin Williams, when looking at dividend companies and judging dividend stocks, I like to look at a few things. One is, are they expected to be more profitable this year than they were last year? In Sherwin Williams' case, this is the case, because look at their trailing P's of 27, forward P's of 20. They're expected to be much more profitable this year than they were last year. That's one of the things I like to look at. The other thing I like to look at is what's their current dividend they pay. So in Sherwin Williams' case, they only pay a dividend yield currently of 1%. That's pretty low. However, their payout ratio is only 26%. So they can up that dividend drastically and still be able to fund the business and all those kinds of things, guys, because a 26% payout ratio, that means of the earnings coming in for last year, you only paid out 26% of your earnings in the form of dividends. The other 75% you just put on the balance sheet, or you invest in different projects, those kinds of things, guys. So Sherwin Williams, they're expected to be more profitable. Yeah, they only pay a 1% yield right now, which is why they come in at number 10, but also they can up that dividend drastically over the next few years, 2018, 2019, 2020, because they're expected to be more profitable, guys. So that's why Sherwin Williams came in there at number 10. Number 9 is Walgreens Boots Alliance, company I actually used to work for from the time I was about 18 till the time I was about 20, worked for Walgreens. So Walgreens expect to be much more profitable. This is a business that obviously they're a pharmacy at the end of the day, right? They have a trailing P of almost 20, but a forward P of 14, so they're expected to be much more profitable. They have a current dividend just under 2%. And they have a payout ratio of about 37-38%. So once again, the company that could definitely up their dividend much more. They're expected to be much more profitable, right? When you go from about a 20p to a 14-ish, you're expected to be much, much, much more profitable this coming year, guys. And this is one of those companies that fights off competitors left and right. You could say Amazon might be getting in the pharmacy game somehow, some way, right? Walgreens is such a convenient place. They're on almost every single corner, you can possibly drive by, right? So Walgreens in a position, to definitely succeed at least the next 5-10 years. Who knows after that? Next one up, number 8 here. Number 8 is a company named Public Storage. They're a storage company, so us Americans, we have the biggest houses of anybody in the world, right? And we still have so much crap we need storage units for it. Public Storage, that is their business here. Look at that. A storage company has a $37 billion market cap. Who would know there's that much money in just keeping people's crap stored away? Oh my goodness. So this company has a trailing P of about a 30. They have a forward P of almost 27, so they expect to be a little more profitable. However, this company pays almost a 4% dividend yield currently. A 4% dividend yield currently. Now, why would this one not be number 1 or definitely way up there? Well, the issue is their payout ratio is about 107%, so which means this past year they paid out more in dividends than they actually had coming in for money, which means they took some money off the balance sheet to pay out in dividends. Now, On the flip side of that, right, they're going to have more money coming in this year. So if you do the math on that, they should have more in earnings this year than they're actually going to pay out in dividends. So, that's why that one's number 8 and it's not, further up there, because they already are so close to maxing out that dividend. However, it's a 4% yield, guys. So that is phenomenal. 4% yield there. Coming in at number 7. Number 7 is the Home Depot. This is one of those rare retailers that has not been really affected by Amazon at all. Now, I believe eventually Amazon's going to really take a serious threat to Home Depot, to Lowe's, but Home Depot has fought them off, and until I see Amazon really take a serious threat toward Home Depot, I'm not really scared about Home Depot going down or those kinds of things, guys. But let's look at the Home Depot here. Home Depot has a trailing P of about a 23, a forward P of under 19, so they're definitely expected to be a decent amount more profitable this year than last year. They have they have a dividend yield currently of a little over 2%. They pay out around 44% of their money in dividends. So this is a company that's getting more and more profitable. They're not even paying out 50% of their dividend, and they got about a 2.3% dividend currently. That's a good solid dividend, guys. So that's why Home Depot comes in there. Number 7. Number 6, good old McDonald's. We all know this fast food giant. McDonald's has fought off competitors for years and years. The food game's changed. Competitors have come in and come out, and McDonald's still stays there and dominates, guys. They just figure out a way to do it. So McDonald's currently, they have a trailing P of almost 27 currently, but that's expected to go down to a 22 this year. So much more profitable this year expected than last year. They pay around a 2.5% yield. And they do pay out currently about 65% of the money that comes in. They do pay out that in dividend. But like I said, a 2.5% yield, a business that thrives don't matter what, pretty much, whether it's a recession happens, anything like that. And they're expected to be much more profitable next year. I bless McDonald's there at number 6. Number 5, ColgatePalmolive, the good old toothpaste and soap company. A pretty safe business there, right, guys? They have a trailing P of around 26, almost approaching a 27. Forward P of about 23 on this one, so they are expected once again to be more profitable. They have a dividend yield currently of about a 2.1%. However, they only pay out 56% of what they have for earnings out in the form of dividends. You compound that with being much more profitable. You compound that with a very safe business, right? Colgate, Palmolive soap, those things are not going anywhere anytime soon. So that's why that one comes in at number 5. Number 4, Clorox, good old Clorox, one of the strongest brand names out there. I mean, when you think of bleach, you think of Clorox. Holy smokes, what a strong brand name that is. They own other brands, by the way, like Kingsford and some of those, but Clorox is the main dog there. So they have about a PE ratio somewhat similar to Colgate there, 26 and 23, so they are expected to be much more profitable, with something I love to judge when judging a dividend stock. They have a dividend yield over 2.5% right now. They have a payout ratio of about 62%. Once again, they're going to be more profitable, or expected to be much more profitable this year than last year. You compound that with the strong brand name, a 2.5% yield. That's a phenomenal dividend stock there, guys. Now coming in at number 4. Number 4 is Cisco. Cisco is one of the biggest food distribution companies in all of the world, especially in the United States of America. So you look at some of your favorite restaurants you go to, their food's being distributed from Cisco more than likely, guys. Now Cisco, this company currently has a trailing P of 26. However, look at how the forward P jumps down to an 18. So that's a much more profitable company this year expected to be than last year. That's phenomenal. Plus, you compound that with they pay over a 2.6% dividend yield currently, payout ratio of about 67%. And I say, well, with the amount, and by the way, that was number 3. I don't know why I said number 4. That was number 3, Cisco there. When you look at that, guys, that's a phenomenal company, because they're expected to be so much more profitable. You compound that with the yield, and then you compound that with what they're paying out currently. They definitely going to have a lot of room to raise that dividend over the next few years. Coming in at number 2. Number 2 is Wynn Resorts, one of the stocks I own. I do not own this one because they pay dividends. However, this is a phenomenal dividend company moving forward. Let's look at this one, guys. So currently, they have a trailing P of 49, super high. but look at the forward PE, a 22. That's a dramatic growth company right now. Now, you guys that follow me, you know why it's a dramatic growth company, because of Wynn Palace and because of the Macau market growing at ridiculous rates right now. Ridiculous rates, guys. This company only has a 1.5% yield, and then it looks really bad, right? Because they have a payout ratio of 76% and that 1.5% yield. But then when you look at it from the perspective of, this is a company that is going to over double profits, within a 2-year time frame, then all of a sudden it's like, whoa, they have a ton of room to raise that dividend up. And Steve Wynn, he loves to pay out dividends. You look at their past dividend history, the only reason they have slowed down the dividend is because Macau got weak, compounded with Wynn Palace being built, which was a $4.2 billion project. Now that they have that out of the way, it's just much smaller projects from here, and the money's just coming in like crazy because of the new property and because of the ridiculous growth. I mean, the growth rate came out of Macau the other day and it was like 26%. It's just astronomical right now, guys. So that's why that is my number 2 favorite dividend stock for 2018 and beyond. What is number 1? You probably could never guess it. Apple Corporation. Who would know? Who would have thought a company that 5, 6, 7 years ago under Steve Jobs, they didn't even pay out dividends. Steve Jobs didn't believe in dividends. And now this is the number 1 dividend company I look for 2018 and beyond, guys. Who would have ever thought that? So Apple, let's look at this one here. They currently have about a 14 trailing PE, a forward PE, trailing PE of around 14, a forward PE of a little over 11, right? So that's super low, and they're expected to be much more profitable. They pay out a current dividend of about 1.75% yield. Not great, but at the same time not horrible. But they're only paying out 26% of the money coming through the door out in the form of dividends, guys. So this company, they're going to be much more profitable, or expected to be this year than last year, okay? We got that. They're only paying out 26% of their money based upon last year. So if they're much more profitable, that means if they kept this dividend the same, maybe they're only paying out 20% of their money in earnings. They can up that dividend drastically and be just fine. They could literally triple the dividend and get a 5-6% yield on this company, right? And still be able to fund the business and fund all the investments if they want, guys, and pay down debt, all that kind of stuff. So that's why Apple, in my opinion, as a dividend company, if I wasn't 27 years old right now and I was 57, I would say a lot of my money would be in Apple stock right now, just because of the phenomenal way they're going to be able to boost that dividend over the coming years, as long as they can keep the business growing or even stagnant. Even if you keep it stagnant, right? Even if they have no growth in earnings, after 2018, still you look at, they can raise that dividend drastically, and you can collect all that dividend money, reinvest it back into Apple stock or another stock, and collect more dividends, guys. So I hope you enjoyed this today. Top 10 dividend companies for 2018 and beyond. Let me know if you guys own dividend stocks specifically. If you only invest in dividend stocks, I would love to hear from you guys in that comment section, hear what you have to say. Here, I would love to hear if you have any other ones you might want to add, maybe an AT&T, maybe a Verizon for whatever reason. Just kind of, state your case, maybe a Frontier Communications. I would love to hear, if you guys have any stocks you own that you're like, this is a really great dividend stock. I would love to see this on the list. I would love to hear from you guys. My book is linked in that description. Check it out if you want. That's my stock market strategy. If you just came across the channel, you may want to subscribe. We talk personal finance in the channel. We talk entrepreneurship, and I'm an actual business owner. I give away so many business tips. We talk stock market investing more than anything. Thank you for watching, guys, and have a great day.